after it becomes available tomorrow, and you can watch the replay if you want to see any of the findings or hear any of the perspectives again. While we're going through the roundtable discussion, the way the format's set today, 45 minutes of the roundtable with the participants, and then we have allotted between 10 and 15 minutes at the end of the session to address Q&A. So if you look at the bottom of your screen, there is a Q&A chat button. Please feel free to submit questions as you see fit during the discussion, and we'll try to address those at the end of the session today. One other item we did ask for questions in advance. So for those of you that did submit those questions, no need to resubmit them during the live session. We'll go ahead and address those to the best of our ability during the Q&A section. So that's it on the housekeeping side. Thanks again for joining us. I'm going to hand it over to Mike Burgess from BlackRock. He's going to go ahead and do some opening remarks, and then we'll come back to me and the team here at Advisor Growth and go ahead and get the panel discussion started.
Awesome. Thank you, Brandon. Again, my name is Mike Burgess. I work in the RIA business here at BlackRock. Very excited to be here with you all. You know, BlackRock is very proud to sponsor this research. A few years ago, we were mostly talking to clients about valuations and financing. Today, our conversations go much deeper around deal structure, differentiation, where scale can have the most impact on a firm's profitability and enterprise value. We recognize how important it's become for just about every RIA to be at least aware of the dynamics on the business side of the industry for the sake of preparedness, and to give themselves the most optionality should they decide to sell, merge, partner, or pass the business on even to internal successors. As we try to be better partners to our clients, we've realized that talking to them about their business is as important as talking to them about our business. Our visibility and contact with thousands of RIAs across the country, and of course, our relationships with some of our best partners like Mercer, Mariner, Cap Trust represented here today, we think gives us a unique vantage point. And the research, along with our partnership broadly with Advisor Growth Strategies, enables us to deliver a lot more value to our clients. So I would just say thank you to Brandon for all the work that you've done, and John and AGS at large, and to Marty, Dave, and Rush for always being willing to talk and share their insight with the population here. So I'm looking forward to a great discussion.
Thanks, Mike. Appreciate that, and we are too. And I think for today we have a couple things. The first thing I want to do is just referencing, as Mike mentioned, why are we here? Why have a panel roundtable discussion around M&A? Of course, it's one of the most popular topics in the space, and as part of our annual efforts, we do our RIA Deal Room Research Report, which is available. And just for everybody who's on this call, you'll get an email with a link to access the research if you've not yet seen it. But just to cover a couple of key topics that you're certainly going to hear a bit about today and are sort of prevalent in the industry at large that we found through our research is really a couple of things. One, of course, 2020 was a pivotal year. Lots of discussion around the pandemic. And we know from the data that's being shared in the industry that it was a record year in terms of number of deals. And our objective this year with the research was to go into why. Why is that happening? What are we finding out there in the space? And I think a couple of the trends that we noticed in the research at large were, one, increased demand in the space for M&A on the buyer side, and new catalysts that were bringing sellers to the market. So some trends were alive and well, such as succession and the need for scale. But really 2020 became a pivotal year and a catalyst that introduced new catalysts that we found in our research this year, namely what we're calling management fatigue and really operational fatigue from running an RIA. And the second piece of it being regulatory and tax uncertainty, which certainly came through the fall of 2020, but we're hearing about again here now in 2021. But the result of such a powerful year in M&A and such a challenging year for all of us going through 2020 with some interesting trends that came out of things like valuation and deal structure. So in particular, we tracked another increase in the median valuation in the space, north of a 20% increase due to increased demand and other factors in the space that we'll talk about today. And then also really looking at deal structures, a preference for cash, but also 2020 brought on some more balance in deal structures in the sense that sellers were being asked to accept maybe less contingent risk in their structure, but being given a lot of upside in transactions to go ahead and, we're calling them, earn more provisions as part of earnout structures in the space. So really what it comes down to is looking into our research. We didn't view 2020 as an isolated event. We viewed it as certainly changes in the M&A environment and the RIA industry at large that are going to drive the narrative going forward. So hence why we're here today. We're talking about it through our research, but really, who best to hear it from than folks that are participating in M&A every single day. So with that, I want to welcome our roundtable participants today. So of course, you have myself, Brandon Kawal, Principal at Advisor Growth, and my partner, John Fury, Managing Partner here at Advisor Growth Strategies. As much as you want to hear from us, I think our three guests are who you want to hear the most from. So we have, do a quick intro. Dave Barton is joining us today from Mercer Advisors. Dave leads a lot of the M&A and strategic efforts at Mercer, as some of you are well aware. Have a fantastic insight into what we're seeing in the industry today. We also have Marty Bicknell, CEO and President of Mariner Wealth Advisors, who is also a key figure and is very well versed in the M&A environment in the RA space, and we'll have some fantastic insights to share. And Rush Benton, who's Senior Director for Strategic Growth at CapTrust, another fantastic firm who's done a lot of amazing work in the space around not only organic, but inorganic growth initiatives. So guys, welcome. Thank you for joining us today. We're going to go ahead and get started. So I'm going to pass it to John and kick us off with our discussion and our questions.
Yeah, thanks, Brandon. Thanks everyone for joining us today. We're excited to kind of talk about M&A, what's happened coming out of the pandemic, and kind of our path forward as we go through these dynamic times in the industry. So we'll keep the conversation conversational. I'll call on one of our panelists, and then everyone can feel free to join in. But we'll just start right on from the top, from the pandemic itself. How is that still affecting the M&A environment? Good or bad? So Dave's nodding his head, so I'm going to go right to Dave Barton. How are things out there post-pandemic, coming out of it?
Yeah, thanks, John. I think COVID is still impacting the M&A space in a number of different ways. I think first, COVID really kind of woke the market up, woke up definitely the smaller RIAs, the subscale RIAs, that they were vulnerable to a sharp market drop. And, literally overnight, their bottom lines disappeared. More than that, they felt the lack of scale real time, right? As their 150, 250, 300 clients, were in panic mode as the market was, plummeting. They had no staff outside of themselves to reach out to those clients and communicate with them, to calm them down, ease their fears. And so they felt the need for a real infrastructure and support mechanism outside of themselves to be able to communicate to their clients in a timely fashion. So that did happen. Also, the presidential election, right, was something that really drove M&A growth in 2020. And the thought there was that a Biden administration might, at the time, increase capital gains taxes. And of course, we now know that they have plans to increase capital gains. And that too is continuing to drive M&A movement. And so those things persist today in the market, John. And I think two other things, and then I'll stop talking. Zoom, video conferencing, what we're doing today, has become commonplace in our market. The adoption rate for video conferencing as a suitable replacement for in-person meetings has occurred. It's happened. A byproduct of that, however, is that because there's, in-person meetings has dramatically dropped off, sellers are doing much more reverse due diligence, right? They must understand that firm at a very deep level because they're not meeting with them in person. And so the only way that they can get to know that firm is by very heavy and deep reverse due diligence. So I see that as part of what came from COVID, but I think it's also here to stay, John.
Marty, go ahead, fire away.
Yeah, John, I think I agree with everything Dave said. I think the only thing I would really add to it, I mean, definitely, the volatility has led to, increased, number of firms looking for an opportunity. But Brandon used the word fatigue earlier, and I think that's absolutely playing into it. I mean, it's a lot for, the one-man band, to deal with today. And, I kind of think you said good or bad. All of those things that Dave said and what I added to it, there's really no bad in that when you're in the business of acquisitions. I mean, whatever the negativity that came out of that has led more firms to test the markets has all been positive to the three of us. And the Dave also mentioned Zoom. I mean, for us, it's really replaced steps 1 through 5. And gives us an opportunity to actually spend more time with a broader perspective of the individuals inside each organization. But we still feel that it's very important that there is the face-to-face component of it towards the end.
Yeah, and I think that's right. The market is certainly very different now than it once was. Maybe one last perspective, then we'll switch and I'll give Rush the opportunity to go first. But we, as a transaction advisory firm, we closed the deal and never met with our client and did the whole thing on Zoom, which if you would have asked anyone in the industry if that was plausible a year ago, they would say you're crazy, it's impossible. So I think when we look forward, this whole notion of co-location is important, proximity is important, what location-wise is kind of out the window. And maybe for now we'll go right to Rush and we'll switch gears a little bit and talk about valuations. Everyone on the call is always interested in valuations. Our research shows that it's up, year over year, 20%, even more so this year. So Rush, what's your take on valuations? What are you seeing out there? They're high. How is CapTrust dealing with it, participating, unsustainable?
They're definitely higher than they were. I think we all recognize that, by a turn or two, it seems like. And that's a trend that's been in place for a while. I was talking to our CFO a little bit earlier today, and we were reminiscing about the days of, 6X being a good multiple to buy a firm. And to be honest with you, it wasn't that long ago. So I do think that valuations are going to remain high as long as there's a lot of transaction volume. There's just too much demand on the buy side. There are too many of us chasing what still really are not that many deals when you come right down to it. I know transaction volume's up, but we all know other industries and firms that are acquisitive in those industries. Look at property and casualty insurance agencies, for example. They'll do 100 deals in a year. We're all doing 5, 6, 7 deals, something like that. And add it all up and it's 120 deals or something. It's still not a huge transaction volume.
So maybe someone else on the panel wants to jump in on this too. So all right, so competition drives up valuations. Obviously, supply and demand. Are there other factors? A lot of people talk about cost of capital. What else is in there? You guys are buyers. You're bidding firms up. You must be getting returns. Dave, you want to start there?
Yeah, I agree with everything that Rush said. And valuations are increasing, and deal structures, as Brandon indicated at the outset, are morphing. They're also getting more favorable. So there's a cash component, John, as you know, but then in the structure, it's also getting more favorable as well for sellers. And I think there is a fatigue out there in the industry among the subscale RIAs. They're really tired of wearing 12 hats. They really are. They don't want to do it anymore. They understand the industry is consolidating. And most important, they're not growing. So X market, they're growing 1 or 2% if they're lucky. And so they know for them to grow in any sustainable, and this is organic growth, direct growth, they're going to have to join someone who is growing. And that helps their staff have career development opportunities, of course, higher remuneration opportunity for staff. So it's a number of different things that are confluing together, John, to drive these valuations, in addition to the serial acquirer set, like all of us on this panel, plus regional firms now getting into the game, right? Because they see this as a suitable replacement for organic growth or diminished organic growth. And local firms doing the same thing. They can't grow organically. Well, let's grow inorganically, right? And so they read the headlines, all these deals being done, they think it's easy. They don't realize how complicated it actually is, right, and how difficult it actually is. But there's definitely more buyers and there's definitely more sellers as they're both aging out, and then also they don't want to wear 12 hats anymore. And last point, they understand that service expansion in our industry is real. So investment management only firms, right? They're literally gasping for air to stay alive. Financial planning and firms that's great, but that's table stakes today. So if you want to be competitive to attract and retain high net worth clients, you better be doing more than that. And so for these firms, it's either build it or join it.
So let's switch gears a little bit, and related evaluations is structure, of course. We're telling our clients, if you foresee your runway in maybe 5 years to exit, at minimum, you should be getting educated on the M&A market. And sure, most advisors that we all run into just focus on, okay, if I did a deal, what's the price? But the terms, the integration, all these things that the panelists have worked so hard to build over the years are probably even more important. So Marty, we'll go to you. What are you seeing in deal structures? How is it evolving? Is that impacting the way you bid or the way you think about finding partners?
Yeah, I think it's interesting. The education and desires of the sellers are, they're more thoughtful today than I remember them 3 years ago. For us, we've been 100% buyers for a while, and the majority of our early deals were cash up front with an incentive put in place for call it 3 years, whatever. Now we're seeing a relatively high demand for equity, and for us, we're okay with that, and really trying to design what that perfect allocation is, for each opportunity. It's more rewarding for us if there's equity involved, and having the spirit of, being partners and continuing the growth of the organization, of lifting all boats. But I've found that people have a more focused desire than any time in the past.
Hey, Brandon, I'll ask you a question about this. For the audience, how is that playing out with essentially the research? When we think about structure, contingent, cash, equity, what's the trends?
Yeah, I think it is interesting. I like the thoughtful comment. I think it's something that's starting to show up in the research itself. As mentioned at the beginning, I think when we first did this research a few years ago, there was you can almost draw a line down the middle between cash and equity, or a third, cash, equity, contingent. And I think where last year we saw this sort of flight to certainty, and I think now we're kind of seeing a relative balance again in structures. And I think the most notable, certainly an emphasis on cash, but I think as Marty mentioned, there seems to be a desire for equity. I think you have to have the right long-term perspective there to want to really participate in that, sort of the shared outcomes. And then, as I mentioned, with contingencies, at least for the moment, in the recent data, we're seeing primarily less sort of put your contingencies at risk and more yes, everybody needs you to deliver the business as we thought we were going to get it to get your full deal price. But beyond that, upside opportunities, right? To be able to come in. And I think a lot of what we're seeing from the market is, hey, let's give you relative confidence in what you're going to achieve through the deal. But then here's how we win together, right? Going forward with these, what we call earn more provisions. But I think this broadly, and I'd love to, this is kind of valuation and deal structure together, and I'd love to get the group's take here, is I think one of the things we try to think about, what are the traps that we're seeing in the current market? So valuations are up, deal structures seem to be fairly friendly. But I think one of the traps that we sort of see with that is it's not the same type of valuation and deal structure for every firm, right? It's not necessarily uniform across firms in the industry based on size and in characteristics. So I'd love to, maybe Rush, you could start in on this, but do you see any other traps that are out there, or maybe perceptions you're hearing from sellers that need to be debunked a bit?
Well, I would want to make one more comment on deal structure, which is obviously if capital gains rates really are going up, I think there's going to be more demand for equity. If I'm, or I'd be happy to roll equity into something and not have to take that tax hit. Maybe I can wait it out, and who knows, where cap gains rates ends up. So I think highly likely we're going to see a bigger demand for equity in these transactions, especially if it's structured correctly as it should be. And then the other thing I'd say is that the industry has evolved to where there are now firms like ours where a seller can look at that firm and see the value in the equity and the growth in that equity. I mean, if you think that you're going to have inorganic growth, to Dave's point, if you're going to have inorganic growth on top of weak organic growth to actually get somewhere and grow, well, then you might as well roll some equity into a firm that's got a track record and the resources and the capital and all that goes into being able to do transactions, to then be able to participate in the consolidation of the industry. So I think one of the traps that just to kind of make that connection, one of the traps is if you take equity in a firm because you're trying to avoid, capital gains rates or whatever, paying taxes now, it's always better to pay later. You better make sure you're doing a transaction with a firm that has got a strong equity position. They've got a safe balance sheet. I mean, the last thing you want to do, you've built a business and you take a bunch of some cash and then a bunch of equity in whoever you sold to, and that doesn't pan out. We all remember they're early in this business of consolidating these firms. There were businesses where that didn't work out too well for the equity shareholders. So I would just say that's a trap. You got to be really careful if you're only focused on taxes and you make a bad decision on a deal structure because of that, you could end up regretting it. And the other thing I would say is it's choose your partner wisely. Like you really are going to be in business with these people, with us. So you better have a partnership that you trust, that you like, and that you're getting more than just economic value out of that partnership. Scale matters. We've been talking about that for a long time, and I think it more so than ever impacts what's happening out there today.
Yeah,
I'll just mention. I was going to mention one quick thing from our perspective, Dave. You'll be interested to hear this based on your original comment on reverse due diligence, and Marty mentioned it on thoughtfulness, and Rush, you just mentioned, RIAs thinking about the stability of firms. We get a lot of questions now about you guys, which never used to happen. People, they came to us for products. Now they come to us and say, you guys have a relationship with them. It's probably in the billions of dollars. You work with them every day. Tell us what they're like. They really are doing their diligence, and they're thinking through. Of course, when it comes to the numbers, they're going to talk to all the rest of you folks on here. But from a cultural standpoint, and from a just approaching you as a company, as people, they really do want to know what it's like, what the differences are, and how to think about your equity position. Again, not the numbers, but from a cultural perspective, which is really interesting.
Yeah, I was just going to add to Mike's comment and Rush's comment. By the way, I agree with both of them. I see two traps occurring here. One is for those sellers who are rolling a percentage of the purchase price into the buyer's equity. You better make sure they're growing. You better make sure that that investment is actually going to accrete in value and not go down in value. So for example, we've got a major player right now in the RIA space, CI, that is buying up every firm in sight and paying, frankly, unheard of multiples for these businesses. They're publicly traded. They're an asset management company out of Canada. But, if you look at their historical stock price, in 2014, they were trading at $32 a share. And this year they're trading at $17 a share. So be careful what you're locking into there with regard to your potential partner. I would also say there's a reverse trap for the buyers out there. You can be so undisciplined in your evaluation and get so out in front of your skis in terms of how you're valuing companies that when a real bear market shows up, not the COVID crash and the shortest bear market in American history of 3 months, but a real like Great Recession type pullback, you're going to be way out over your skis and potentially over leveraged. And the return on that investment that you're buying, right, is going to take far longer to recover those monies. So I see it on the buyer side, and I also see it on the seller side.
Hey, panel. So let's talk a little bit about your firms a little bit when it comes to M&A. So what I always how I like to think about M&A, you should be agnostic to being a buyer or seller and evaluate a transaction for its merit. So what's great about you guys is you've done sell side transactions too. We have Mercer on the third sponsor, CapTrust did a transaction, and Marty, just very recent announcement. So maybe I think it would be interesting for the audience to understand what you're looking for out of a partner. So Marty, it's fresh in your mind, I'm sure. So yeah, maybe a little transparency into your recent transaction.
Yeah, no, happy to spend some time on it. I think, for us, we were really looking for, and I think it's probably similar to everyone, is looking for a partner for growth, a capital provider, somebody that is willing to, continue to invest alongside us, as we execute on the opportunities that are in front of us. I think another thing to think about is, what a potential partner brings to professionalizing the firm. The industry is very fragmented, very mom and pop-ish, and really focusing on firms that are true enterprises and not just a larger practice, and what that difference means and what that difference can really bring to you, from a future perspective. I think as firms, really look at this, whether they're buying or selling, understanding what the tools and resources are that will be made available, and how are you going to use those to trigger growth? Because growth is what this is all about.
Brandon, you wanted to go ahead, Brandon?
Yeah, I think it's interesting, and I'll just a short comment on the research side. But I think us as a firm, we probably talked to between 12 and 15 different outside capital providers that have reached out, interested in getting into the space. And I think something that Marty mentioned, I think is so important. We get inquiries from RIAs like, hey, what would it take to take on that type of partner? And I think the looking beyond the word capital partner is so important, because yes, you have a capital partner, but to Marty's point, whether it's some sort of strategic capabilities, professionalization, some value that those folks are bringing from the outside, and that's where they're looking to frankly impact the industry at this point, is bring knowledge and know-how and capabilities that they've learned from other industries. And I'm curious, Rush, if you guys had the same experience as you were looking through doing a transaction as well.
We raised money about a year ago, and what I would say about that is a few things. One is we have a very strong culture of employee ownership. And when you have everybody top to bottom in your firm invested in the company, and the opportunity comes along to maybe take a little money off the table and de-risk a little bit, that felt pretty good because, you know, it was an opportunity for us to sell a minority interest in the business to a private equity partner. We chose that partner very carefully. We had a few stipulations there. One is they could not ever control the company. So there's a you know, there's very much an entrepreneurial spirit still alive, as I'm sure you guys still have, but they can't control the company. They can't control our exit or what we do. And that was nice. It's growth capital. We had the opportunity as we started to look at this, you know, the acquisition activity is accelerating, and the deals are getting larger. So that requires more capital. And we could either leverage our balance sheet and continue to go it alone, which was the last thing we were interested in doing. So we brought in some equity capital. And then the final thing I would say about that is it validates your price. Because if you're a privately held business and you're you know, you've got your own metrics by which you value yourself, it's nice to have a third party actual transaction validate that, not just you know, there are plenty of good valuation firms, you guys do that, but it was good to really be validated. And it also, given the valuation we got, it validated scale. Scale's expensive. It's hard to create. It's a lot easier. Dave, you fired shots at CI, so I'll throw another one in there. I'm sure they're great, and they've bought some great firms, no question about that. That we would like to have bought. But, you know, there's a validation in building scale and doing the hard work of giving somebody a check plus some equity, and then having the hard conversation about which employees are going to be able to stick around or not, or how are we going to integrate your investment process into ours, or I know you love Tamarack, but we're on Black Diamond. Those are not easy conversations, but it creates scale. And we feel like our transaction with GTCR last year actually validated the hard work of that scale by putting a really good multiple on our business.
That's great perspective, Rush. I couldn't agree with you more. I think you know, for all of you out there considering a transaction there, you really have to understand what you're going into it, the transaction purpose, and how you, what we like to say here, how you come through the transaction, what it's going to look like in 2 or 3 years, because no one wants to bust the deal. It's very difficult. No one wants that unforeseen consequence. So, all right, let's talk about the future of M&A. Can it keep the pace? Is there anything that would, you know, make your firms pause, slow down? You know, I remember, you know, even Marty and I talking, I don't know, about a couple of years ago, Marty took a break, valuations are up, and now maybe the gas is down a little bit, but the pedal's down a bit. What is Marty, we'll start with you. What's your perspective? Still pedal to the metal?
Yeah, I think, you know, the number of firms coming to the market, I mean, it's not going to slow down anytime soon. And you know, I think that there's a group of group of firms that might get priced out, but there's going to be plenty left that aren't priced out. And, you know, you made the comment of us taking a break. I mean, we had a strategy of, you know, doing, you know, 4 to 6 deals in a year, taking the next year off to integrate and do all that stuff, and then, you know, repeat. And you know, quite frankly, you know, it was because we had to. I mean, we were self-funded, and, you know, now with the capital provider, you know, in the infrastructure built, you know, the need to do those breaks, you know, doesn't exist anymore. And I think there's probably close to 10 firms, including Rush and Dave's, that you know, don't need to take a break for break's sake. And, you know, if one's chosen, it's just maybe the market chooses it for us.
Dave, what are your thoughts? Any
Yeah,
signs of slowing down? What would make you pause?
I mean, it's definitely not slowing down anytime soon, John. I totally agree with Marty's comments. The pace is going to continue. It actually might even accelerate this year, which is hard to believe. But I believe 2021 will actually be a more frothy market than 2020. Certainly, as valuations continue. I would caveat that, however. The registered investment advisor space is an independent market, and not everybody's for sale. And so this gold rush that we're in is not going to last forever. No gold rushes last forever. What inning we're in of this gold rush, hard to say. But it's definitely not going to go on forever. And there are people who want to remain independent and will remain independent, and that's fine. And there's technology solutions out there that will allow smaller firms to stay relevant. Will they grow substantially? No, they're not going to, because the larger firms, the Pareto rule is going to roll into effect. 20% of the firms are going to control 80% of the market. But that doesn't mean that they may sell, because they might be happy being $150 million RIA or a $200 million RIA or a $300 million RIA and be perfectly fine and have an internal succession plan. So it doesn't mean that it'll go on forever. I think in the near future it will, and I think pricing will continue to go up. But there will be a point at which that arbitrage narrows to an extent that it'll slow the buying spree.
Dave brings up such a great point. There of course is room for everything, right? There's plenty of firms that we work with that, the founders and the team want to make, next gen equity work, internal successions, and all those mechanics. And I do think there is the capital markets are aiding that. I mean, now it's a lot easier to get debt financing. It used to only be seller financing in days past. So I think behind the scenes, public deals are being reported, but there is probably, I don't know, Brandon, you might have a point of view here. There's at least 5x internal deals happening that are unreported. So it's happening. I wouldn't deem an internal transaction an M&A transaction, but there is a lot of equity exchanging hands currently.
Yeah, I think it's a really important point, because I think to Dave, something that Dave said I would echo is not everyone's going to do M&A, and we asked the question, how interested are you? And roughly half say they're not really interested in M&A at all on either side of the table. I think it's important to stay knowledgeable what's happening in the M&A market, because I do think it's creating some pressure on traditional business management and succession, but it doesn't mean it's the only option, right? To that extent. And I think, John, you're right. We're seeing multiples of that internally, and you do hear from a lot of firms in the space that the goal is to carry on, and have the firm be sustainable beyond them, or go to a next generation of talent. And I think all the market for me is really suggesting at this moment is you're going to have a lot of conviction in that and understand the trade-offs, right? That's really it, and really be firm in that belief, because when you look outside, there's a lot, there can be a lot of reasons to depart from that. So being really clear on the strategy to going forward is critical from my point of view.
Hey, Brandon, I've got a quick question for you from the research. One of the things we missed during COVID is we didn't get to see each other at conferences and conventions, right? Where we would always have a panel and there'd be a bunch of people out there, and the question was always, are you a buyer or a seller, right? And everybody's a buyer, right? Nobody's a seller. Do you think that's still the case? I get the sense that there are fewer firms that think their path to success these days is through being acquisitive, and they're shifting more over to, we tried that and it was really hard and it was expensive, and maybe I'm more of a seller now than I thought I was.
There's still, it's still a bit lopsided, in our survey, the survey we did this year, it's still about 3 times as many firms say they'd want to be a buyer than a seller. But what we did see underneath that, more firms, to your point, were upfront that they are at least interested in exploring the sell side, right? And really more so than we've seen in years past. So I think that gap is closing a bit to your point. And I think a lot of what's driving it, and I know you've all mentioned it at different times, is, we kind of look at, well, why do M&A? Why do anything? It points back to growth. And I think in the end, organic growth. And a lot of, I think firms, 2020 kind of forced you to reconcile or come to grips with, how are you growing, right? How effective is your organic strategy? And should you be looking at alternatives in the space, or really heavily investing in your own infrastructure to get that online? So I think there's an open-mindedness that we're seeing, although, not a complete flip-flop, definitely more open-mindedness, to your point, Rush, that's out there with RIAs.
Just a quick comment on that. I think one of the things that's interesting, Rush, to the point you're making, and Dave kind of mentioned it, is people raise their hand that they're interested in doing an acquisition, and then they realize how difficult it is.
Yeah.
It's not easy, and as difficult as it is to do a deal, it's more difficult afterwards. All the stuff that needs to be done afterwards is more difficult than the deal itself. And I think that might be scaring people away from it.
I think that's such a great point, Marty. I agree. It's integration as a unique strength as a buyer is incredibly important. And our team as transaction advisors, we're looking for that, and we're testing for that. We know all you guys and your capabilities, but if there's someone maybe not as astute, we're testing for it. So I think it's super important. So, all right. So for our audience, we're going to go to a Q&A after one more question. We have pre-submitted questions, which was awesome. So thanks everyone for that. So if you have questions, please go ahead and fire them in and we'll try to get to them. So one last question for Marty, Rush, and Dave. What advice would you give somebody that's trying to educate themselves, or maybe, be on the sell side? What would you tell them to perhaps prepare for a transaction? So Rush, maybe we'll start with you. What's your advice? How to best prepare?
Well, I think the universe of buyers is fairly well known. So it's not too difficult to kind of figure out who they are, and we're all receptive. If you want to just pick up the phone and call, we're happy to talk about what we do and how we do it. There are a lot of different models out there. I'd say even on this panel discussion, you've got kind of 3 different models to some degree in what we're looking for and how we do it. But the one thing that comes to my mind is, and this is maybe in the weeds a little bit, but it is to not, this is practical advice if you're going to sell your business, do not overpromise to your employees what they're going to get out of a transaction. I mean, when firms integrate, you may have the best compliance person ever for a firm with 10 employees. But we've got 900 employees and 6 or 7 people in compliance. I'm just expressing a little maybe frustration, because in a seller's market, the employee base has to be catered to. And I'm not saying they shouldn't be catered to, but when you're going to integrate a firm, every employee doesn't necessarily have the opportunity to keep their job at the same level in an integrated organization. And as loyal as we all are to our employees, a lot of small RIA owners, I think, sort of overpromise on the front end to their employees what they could expect from a transaction. That's a little bit in the weeds and a little bit maybe too practical, not high level enough. But look, it's a business. It's not a lifetime promise of ever increasing compensation and employment, regardless of where you as the owner take the business. So be careful about that. Conversations with employees, if you're starting to talk to seller or potential buyers, be careful with your employees as to kind of what expectations you set.
Yeah, I think I would add on to what Rush said by sellers really understanding their own business. The reason bankers get hired like AGS, which is a great firm, is they know how to tell the story about somebody's business. They scrub the numbers, they clean the financials. So if you're a seller, you want to make sure your financials are clean. They're not a mess. They're not a dog's breakfast. Make sure they're in accordance with GAAP, right? Don't have crazy adjustments in there. And then also understand the demographics of your own client base, right? What's the average age? What's the average AUM? What's your client tenure rate? Are you attriting clients? At what rate? How many clients in distribution phase versus accumulation phase? You want to know all these things. Of course, growth. If you're growing, sing it from the loudest and highest place possible, because that's a selling point. So really go deep on your own numbers, really understand them, and present them fairly and honestly. Don't goose or gas anything, because trust me, sophisticated buyers will find out what the true facts are in discovery. So be fair, be honest, but be complete.
Yeah, I think the only thing I'd add to both of their list was, to really think through what the ideal situation looks like for you. Make a list of things that we call non-negotiables. The thing I would focus on is, it's a competitive environment, so valuations really will be what they are. The most, really confident that the three of us, have a valuation philosophy, that's within a relatively tight band from one another. And so it really should be about, what the culture of the organization is, what are the things that it brings to you, and how you feel like you will operate inside that. As Dave and Russ have indicated earlier, there may be a firm or two out there that, their calculator doesn't have a battery in it. And I would just, be careful of what you wish for.
I love that. That's a great analogy to kind of wrap it up. It's buyer beware. You got to know your counterparty really well. So I'll turn it over to Brandon. We'll go to audience Q&A. So thanks everyone for the discussion so far.
Yeah, so I think appreciate that. So we'll jump into, I'm going to start with the pre-submitted questions and we'll roll through them. The first being, this firm was mentioned as we've been going through it. So you have new entrants, and I'll put it, we mentioned CI Financial as one that's been highly active, and I think there's just a breadth of options in this space, and a firm like CI has come in and made a big mark in the industry over the last 12 months. But I'd say CI and the other options that have been available that you're all competing with day to day, what impact is that having on the industry, good and bad, right? What's your take on sort of the plethora of options now that's available to the industry?
I think it's great that there's so many options available to sellers, and Marty said it best, right? You're not going to have any shortage of choices, but make sure you're matching up to the best available choice for you. So do your homework, make sure that there's cultural alignment, and what does that mean? Just make sure your mission, your vision, your values, your core beliefs are the same between the two parties, because it's not about the honeymoon. It's about the marriage. So make sure that cultural alignment really, really exists, and it's strong, and it manifests. And understand the day after. Understand the day after. What's your role the day after? What's your compensation the day after? What does it look like for your staff the day after? So be complete.
Yeah, I would add to that. Just make sure you know what you're trying to solve for. Like, why are you interested in doing a transaction? And then go find the partner that best solves what you solve for. And so CIs, for example, they've bought some really large firms that I think were just trying to solve for succession and liquidity, not necessarily looking for scale, not necessarily looking to plug into a bigger this or a bigger that, as far as I know. Smaller firms, to give you an example, we're closing on a firm here in a couple of weeks. Good sized firm, $1.7 billion, $2 billion, something like that. They did a 10-year strategic plan. That's what they wanted to solve for. And they looked internally at themselves in the mirror and said, you know what? This is going to be a tough 10-year plan to achieve. Do we really want to be the ones doing that, reinvesting our own capital back into the business to build the kind of stuff that we are trying to solve for, which was all client-facing kind of stuff? So they wanted to solve by doing a transaction with a firm that had already built all that stuff. So very well-defined goal for a transaction, found the right partner, and I think the marriage is going to be good. I love that.
Yeah. Awesome. Yeah, it's if I could summarize, know what you're signing up for and why, right? In the transaction process. Next question that we have from the audience. So we talked a little bit about this notion of management fatigue, and somebody asked if that fatigue is leading to an increasing number of sell and go away deals for smaller seller firms. I maybe Marty, we could start with you here. If you're seeing that or seeing people request that more and more in the space, and then I certainly have an opinion or two to share on that as well.
Yeah, it'd be interesting to hear what Dave and Rush have to say about this, because we haven't seen that. You know, we've done 24 acquisitions. We're actively engaged in 10 right this minute, and we haven't lost a founder yet. And you know, in our conversations, they may want the freedom to focus on something other than they're being forced to focus on now, which typically leads to rejuvenation and, you know, love of their job again. And you know, it's a lot of fun to be able to provide that.
I just tackle exactly what Marty just said. We're not seeing anybody leave the business, right? The moment that they can offload all those things they hate doing, compliance, HR, legal, and they can focus on the things they love, whether it's client service and winning new ones, man, they are reinvigorated. They want to stay. They want to keep going. We're not seeing any exits. I'm not seeing any exits at all. People want to stay and be part of the going concern, particularly if they're rolling stock, right? They want to stay.
Yeah, we're seeing that in our business too. I think we're right around good or bad. We try to coach most of the folks that we're chatting with that you have to view this as a marriage isn't the term that we use, but a partnership, right? You're going to a new platform to get different and new things that you're seeking for. Certainly liquidity could be part of it, but I think both of you made the point that you have maybe life when you get those things that you were looking for through the transaction, and you're reinvigorated to stick around for a while. So yeah, we're not seeing much of that either. Okay, and maybe I'm going to start off this one. There was two questions about the terminology that we used in earn more versus earn out. So one was given examples. So I'll start with earnouts generally are a broad encompassing term. So the way we phrased it in this year's research is sellers are being asked to put more or less of their initial deal price at risk through earnouts. So right, historically, you might have said, well, you know, over the course of 1-2 years, we'll take away from your initial deal price based on certain metrics. That's still out there. Someone asked, is that a risk management tool that's gone away? I don't think it's gone away. I just think the market's put pressure on your ability to ask a seller to put the initial valuation, you know, up front at risk, unless there's a really good business justification to do so. So, you know, to my comment earlier that not all sellers are going to be the same, I think that's very true in the industry. Situationally, you're going to see maybe more earnout, more at risk. It's going to really depend on the situation, and I'd love to get opinions from the panel here. But as an example of what we call earn more, just to address that directly, really, if you think about separate the initial deal price, the initial valuation, and look at, hey, if we achieve things together, you can actually earn more in the valuation construct. And by the way, we'll help you do that, right? The resources that we bring to the table, the people we surround you with. And that's a very different, you know, conversation for sellers who are looking at a finite transaction. Now it's, well, here's how we go forward together. Equity, of course, could be part of that, but we're talking about cash and incentives here. But I guess, you know, Marty, maybe, you know, have you weigh in on that too, you know, and just an opinion on the risk that sellers are being asked to take in their initial deal.
Yeah, I think just from a personal perspective, the way we think about it is when we use the term management incentive versus an earnout, and we think about it from the perspective of we're not reducing our upfront valuation, but we're putting a metrics in place that over a 3-year period, the key individuals driving that specific business can participate in the growth over the EBITDA that we acquired, and giving them the opportunity to really, you know, come in and get energized by it and understand how they're going to benefit from the continued growth and the utilization of the resources. So, you know, we use it just as as a motivation for continued growth.
And perfect. Thank you for that. And I'd love to get this question. So this is for all three of you, somebody in the audience. Just at a high level, maybe 30 seconds each. One of the audience members asked, it'd be great to hear, what are you looking for from firms that you acquire, right? Are there specific characteristics? Are there things that really signal a great transaction for you, a great group? I think Rush, you alluded to this with the one you're working on now. So maybe we'll start with you, and you can talk about that. Any specific things you look for when you acquire?
Yeah, it's a great question. We're looking for firms that want to fold in and become part of something bigger and tap into scale, and they're willing to take, call it 30 to 50% of the consideration in our equity. And we want them to kind of buy in as opposed to sell out. That's really, really important to us. We've passed on several deals where the seller just wanted too much cash. They just wanted to, take a lot of cash and walk away in 2 or 3 years. And that's just not what we're doing. We're trying to build something where we're all pulling in the same direction. And the common thread there is that we all own the exact same equity, the same form of equity that we all do from top to bottom. So firms that are looking for scale and really want to grow by tapping into that scale, that is highly interesting to us. So that's what we're looking for.
I would add to what Rush just mentioned. It's a really good point. We're integrators, not aggregators. So they're joining our team, getting our systems and platforms and benefiting from our scale. So as Rush indicated earlier, and Marty mentioned it, it takes years and tens of millions of dollars to build true scale. So it doesn't happen overnight. The three firms here on this call all have scale. So they can join that scale, be part of a team. So I call it one team, one dream, right? And together we're going to build enterprise value. We're going to grow stock value. And we love it when we have sellers that want to roll a percentage of their purchase price into Mercer equity, right? And sit in pari passu with us, and let's lock arms, let's roll forward and really grow this thing together and win together as well. And in that way, also make sure that the cultural alignment and the sharing of mission, vision, values is there, because that's bedrock for any successful transaction.
Yeah, I think everything that Rush and Dave said holds true for us as well. There's just one incremental thing that I actually put as number one on our list, and that our strategy is a talent acquisition strategy. I mean, we really are looking for the opportunity to add talent, nationally throughout our organization. And everything that was mentioned is important, but that's really important to us, as I'm sure it is to them as well.
Awesome. Well, I think, so thank you. We didn't get to all the Q&A for the audience, but thank you for all the great questions. We'll try to make sure we address them separately, but we've reached our time for the panel today. Dave, Marty, Rush, really want to thank you for all the fantastic insights you've shared today. Mike, John, same to you. It's been a great session. Thank you everyone for joining us. As we mentioned, you will have access to the recording after this is done and dusted for today. But thank you everyone for joining us, and have a great rest of the week.